Ladies and gentlemen, it's December 30th, 2025, and I need you to look at your screen right now. Look at those red numbers flashing in front of your eyes. That sick knot in your stomach. That tightening in your chest. That creeping panic whispering that maybe you made a terrible mistake. Silver is trading at $75. Less than a week ago, we were celebrating all-time highs above $80. We were talking about the unstoppable squeeze, about triple digits being inevitable, about silver finally getting the respect it deserves. And now, seemingly out of nowhere, the floor has dropped out. We're down 8 to 11% depending on which exchange you're watching. The chart looks absolutely broken. The uptrend that seemed so unstoppable 72 hours ago now looks like it never existed. And the mainstream media, Bloomberg, Reuters, CNBC with their smug commentators who never believed in the rally, they're all singing the same song. The bubble has popped. The rally is over. The silver squeeze was a fantasy that's come crashing back to reality. Sell before it goes back to $50. Cut your losses. That's the narrative being pushed across every financial network. I'm here to tell you something very different. What you witnessed today wasn't a crash in any meaningful sense. It wasn't a correction based on weakening fundamentals. The supply shortage didn't suddenly disappear overnight. The industrial demand for solar panels and electric vehicles didn't evaporate. The structural deficit that's been building for years didn't reverse itself. What you witnessed was a trap, a specifically engineered, mathematically calculated, perfectly timed, margin-driven liquidation designed to shake out the weak hands, to terrify retail investors, to force selling from over-leveraged traders right before institutional money floods back in January. This is not conspiracy theory. This is exactly how the game is played at the highest levels of finance. Let me show you exactly what happened. On Sunday night, while most of America was sleeping, the CME Group made an announcement. They were raising margin requirements on silver futures. When you trade silver futures, you don't have to pay the full price up front. Instead, you put down a deposit called margin. If silver costs $80,000 for a standard futures contract, you might only need $15,000 in margin. The exchange gives you leverage. This creates incredible opportunity, but also massive risk. If the price moves against you and your account drops below a threshold, the exchange sends a margin call. Add more money now, or we close your position automatically. So what did the CME do Sunday night? They increased the margin requirement from $15,000 to $20,000 or $25,000. If you were maxed out before this announcement, you're now undercapitalized. When that margin call hits Monday morning at 9:30 a.m., your broker's computer system hits the sell button automatically, instantly, without hesitation. Your position gets liquidated. No choice, no waiting for recovery. Now multiply that by thousands of traders, all getting margin called at the exact same time, all forced to sell simultaneously into a market with no buyers because it's holiday week and the professional desks are empty. This is a liquidity cascade. This is forced selling. This is why the price didn't drift down slowly. It fell off a cliff in hours. It wasn't rational sellers making careful decisions. It was computer systems automatically liquidating thousands of positions all at once during the worst possible time of year. Today is December 30th, the ghost week, the dead zone, when the real money is gone. The senior risk managers at big banks, the institutional whales with capital to stabilize markets, they're all in Aspen, the Hamptons, on yachts in the Caribbean. They're not at their Bloomberg terminals. They're not watching markets. They're not available to buy the dip. So who's running the market? Junior traders, the B team, and algorithms that follow pre-programmed rules without understanding context or fundamentals. In a normal market week, if someone dumps 1,000 contracts of silver, there are buyers waiting to absorb it. The price barely moves because there's depth in the order book. But during Ghost Week, there are no buyers. The order book is hollow. When the CME triggers forced selling, when thousands of contracts hit the market at once, there's nobody to catch the knife. The price crashes, free falls, gaps down through level after level. This drop to $75 is a liquidity illusion, an air pocket. The sellers were forced to push the button, and because professional buyers were on vacation, the price free fell until it hit technical support around $75. Every algorithm sees this red candle and interprets it the same way. Sell, get out, the rally is over. But you have to ask the fundamental question. Is this the real price? Is $75 an accurate reflection of supply and demand, of the structural shortage, of the industrial demand that drove this rally? Or is this just what happens when you force liquidate leveraged positions into a holiday week vacuum? Here's where the story gets really interesting. While New York is panicking at $75, while American investors are getting shaken out, let me tell you what's happening in Shanghai. The Shanghai Futures Exchange front-month silver contract is trading at 20,730 yuan per kilogram. Let me do the conversion. That's roughly $2,839 per kilogram. Divide by 32.15 troy ounces per kilogram. That gives us $88.30 per ounce. While your broker shows $75, while the futures market in New York says silver crashed, China is paying $88. That's a $13.30 spread, an 18% premium. Chinese buyers are paying 18% more for silver than American traders right now. In global commodities, an 18% spread on a fungible metal like silver is impossible. It shouldn't exist. It violates basic principles of efficient markets. Arbitrage traders should be buying every ounce in New York for $75, flying it to Shanghai and selling for $88. Risk-free $13 profit per ounce. With this spread, arbitrage traders would normally close that gap in an hour. So why isn't it happening? Why is the spread widening from $10 last week to $13 today? Because the arbitrage is broken. China's export licensing system has severed the mechanism that keeps global prices unified. You can ship metal into China and sell it there, but you can't easily get it back out. Export licenses are extremely difficult to obtain. The Chinese government wants silver flowing in, not out. Western banks look at that $13 spread and calculate the risk. They're terrified of getting capital trapped inside China right as geopolitical tensions rise. They're terrified of shipping 1 million ounces to Shanghai, getting paid in yuan, and discovering they can't convert it back or retrieve the physical silver. This fear has paralyzed the arbitrage desks. The West has become an island. The COMEX has become an isolated ecosystem of paper trading. Speculators and algorithms betting on a screen number, completely disconnected from physical reality. On this island, the price is $75 because speculators are scared, reacting to ghost week low volume and margin calls. They're trading sentiment, not fundamentals. But in the real world, in factories that actually consume silver, in solar panel plants and electronics facilities, the price is $88 because the factories are hungry, because supply is tight, because Samsung and Tesla and Chinese solar giants don't care about your chart pattern. They care about securing the metal they need to keep assembly lines running. And they're voting with billions of yuan that silver is worth $88, not $75. This creates a bifurcated market. We now have two silver markets, and they're telling completely different stories. Market A is the paper price, $75, set by futures traders and forced selling. Market B is the physical price, $88, set by industrial users who actually need the metal. And history tells us how this ends. It ends with the paper market collapsing into the physical market. It ends with reality asserting itself. It ends with a delivery squeeze. Think about it from an industrial buyer's perspective. You're the procurement manager at Apple. You need thousands of ounces daily. You're watching silver trade at $88 in China and $75 in New York. Where do you buy? Obviously, you buy in New York. You drain the cheap market. You take delivery on the COMEX at $75. You ship to your factories before the price snaps back to $88. This is why COMEX inventories have been plummeting. Smart money, industrial users who actually need silver, are using this temporary discount to clean out Western vaults. When the COMEX runs dry, when they can't deliver against all the contracts demanding physical settlement, the price won't just go to $88. It will gap to $100 overnight. Maybe $110 or $120, because now you have a real shortage. This arbitrage breakdown isn't a sign of weakness. It's exactly the opposite. It's a sign the paper market has lost control of the physical asset. The disconnect between perception and reality has grown so large it cannot be maintained. The fact that the spread is expanding tells you pressure is building, not releasing. Chinese buyers are getting more desperate. The physical shortage is worsening. It's like a dam holding back a river. The water level is rising. The wall is cracking. When it finally bursts, the flood will be biblical. Why are they smashing the price now? Why force this liquidation 3 days before year end? Why not wait until January when liquidity returns? Because they know the dam is about to break. And before it breaks, they want your shares. They want your silver at $75 so they can sell it at $90 or $100 next month. They want to trigger your fear. The mainstream media will tell you this crash was just profit taking. Silver ran up 150% this year. Of course traders are locking in gains. That's natural, that's healthy. And that's partially true. Some traders saw silver at $80 and sold after buying at $30. That's normal and prudent. But profit taking doesn't cause an 8 to 11% crash in one session. Profit taking is gradual, distributed over time. Healthy profit taking doesn't create massive red candles or crater the market during the lowest volume week of the year. What we saw wasn't profit taking. It was forced liquidation, margin-driven selling, computer systems automatically closing positions, panic and capitulation from over-leveraged traders with no choice. The China price proves this narrative is a lie. If this was truly healthy profit taking based on weakening fundamentals, Shanghai would be at $75 too. Chinese buyers would be backing away. The physical premium would be narrowing, not widening. Instead, Shanghai is paying an 18% premium. Chinese buyers are more aggressive today than last week. The physical market is tighter today than when silver was at $80. The fundamentals haven't changed. The shortage is still there. The only thing that changed is the price on a paper contract during a holiday week market with no institutional buyers. So is the silver rally over? Short answer, no, absolutely not. Short term, expect continued volatility over 2 to 4 weeks. Margin calls aren't done. We could see silver test $73 or $70 if panic accelerates. The chart looks broken. Technical traders will be selling every bounce. Medium term, Q1 2026, the fundamentals are still incredibly bullish. Let me explain why. First, the market is running a structural supply deficit of over 200 million ounces annually, roughly 20% of total global supply. Mines cannot keep up. New mine development takes years and billions. This deficit is getting worse. Second, industrial demand is exploding. Electric vehicles, solar panels, 5G infrastructure, AI data centers, all silver intensive. Demand from green technology alone is up 30% year over year. That's actual measured consumption. Third, China's strategic positioning is crystal clear. They're hoarding silver. That $88 price is industrial buyers securing supply because they know shortages are coming. Fourth, multiple governments have added silver to critical minerals lists. This opens doors to strategic stockpiling and government purchasing programs. Fifth, even after this brutal crash, silver is still up roughly 150% year to date, one of the best performing assets of 2025. That doesn't happen in a bubble. That happens in a market undergoing structural repricing based on real supply and demand. So yes, the rally will continue, but not in a straight line. We'll see violent swings, 10% moves both ways. This is a volatile, leveraged market being whipsawed by forced liquidations and thin liquidity. Let me be honest about the real risks. If global growth slows in 2026, if we see recession, if industrial production falls, silver could give back gains to $60 or $65. That's possible. The other risk is investor sentiment. If risk appetite returns to markets, if the S&P 500 goes on a massive tear, capital flows out of commodities into equities. Silver becomes yesterday's trade. These are real possibilities. Anyone telling you silver is guaranteed to hit triple digits is either ignorant or selling you something. And here's crucial context. Silver didn't crash alone. Gold also fell sharply after reaching record highs above $2,700. Platinum dropped. Palladium dropped. The entire precious metals complex moved together. This tells us the move is market-wide, not silver-specific. When the entire sector corrects together, it usually recovers together. So what should you do? If you're holding silver at $60, $70, or $79, do not panic sell. The fundamentals haven't changed. The China premium proves the physical market is tight. This is a technical shakeout, not fundamental collapse. Sit tight. Turn off your broker app if needed. Reevaluate in 2 to 3 weeks when liquidity returns. If you're thinking about buying, this might be a decent entry point eventually, but wait for stabilization first. Don't catch a falling knife. Let the forced selling finish. Let liquidation run its course. Wait for signs the selling has exhausted itself. Maybe sideways consolidation around 73.75. Maybe a bounce that holds. Then consider entering. If you're trading with leverage, you're playing with fire. This market is eating leveraged traders alive. The CME can change margin requirements anytime with zero warning. If you must use leverage, keep position sizes small and stops very wide. Let me zoom out. What you witnessed is a reminder that markets are not rational, efficient, or fair. A margin requirement change during the lowest liquidity week can crater the price 8 to 11%, even though the underlying fundamentals, the supply shortage, the industrial demand, the China hoarding, literally none of that has changed. This is the game. Technical factors can overwhelm fundamentals short term. Forced selling creates opportunities for patient buyers who understand what's happening. Fear can be manufactured. The people who keep their heads when everyone else is losing theirs make generational wealth. The question is, are you going to sell because a chart looks ugly or the media told you the rally is over? Or will you think independently about what silver is actually worth based on supply and demand? China is answering by paying $88. Chinese buyers are answering by securing supply at an 18% premium. The mines are answering by running deficits they can't close despite silver being up 150% this year. The paper market can pretend silver is worth $75, but the physical market knows better. And eventually, always, the paper price converges to physical reality. It's gravity. You can defy it for a while, but not forever. How long will convergence take? Could be days, weeks, or months. Nobody knows exact timing. Anyone who tells you they know exactly when silver will hit $90 or $100 is lying. But the direction is clear. The trend is intact. The fundamentals are overwhelming. This crash to $75 isn't the end of the silver story. It's a chapter, a painful chapter that tests your conviction. The chapter that separates tourists from investors, weak hands from strong hands, gamblers from thinkers. The trap was set for the weak. The margin calls were designed to shake out leveraged traders. The ghost week timing was perfect for inflicting maximum pain with minimum cost. But the opportunity is for the patient, for people who understand what's happening, for people who can see through the manipulation to the fundamental reality underneath. Choose wisely. If this analysis helped you understand what really happened today, hit that subscribe button. We're tracking this market as it unfolds into 2026. This is just the beginning. The real volatility, the real moves, the real opportunity, all of that is still ahead. And remember, the fundamentals haven't changed. The shortage is still there. The industrial demand is still there. The China premium is still there. All that changed was the price on a screen during a holiday week when nobody was paying attention. Don't let a technical shakeout steal your conviction. Don't let a margin-driven liquidation convince you the thesis was wrong. It wasn't. You weren't wrong. The market is just doing what markets do, shaking out weak hands before the next leg higher. See you in the next one.